Good afternoon, ladies and gentlemen, and welcome to the Schroder Real Estate Investment Trust Limited half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet Company dashboard. Before we begin, I would like to submit the following poll, which will just appear on your screens now. And I would now like to hand you over to Head of UK Real Estate, Nick Montgomery. Good afternoon, sir.
Good afternoon. Thank you very much, Jake, and welcome everybody to our interim results presentation for the 6 months ending 30 September. So it's usual tag team, myself and Bradley. So thank you for attending and thank you for your support for those of you who are already shareholders. So alongside the results today, we have also announced a strategic evolution and a set of proposals that we will be putting to a shareholder vote in mid-December, and more on that in due course. But I think we wanted just to start by saying, and hopefully this has been consistent through various times we've presented on this platform, that our overarching focus here is to deliver an attractive and sustainable dividend by improving the portfolio quality, very much active asset management and operational excellence. And I have to say, we do feel like we've made good progress, and we hope that is reflected in the results today. I guess just high-level points on this first slide. We are well positioned, we believe, because we have high income yield and we have a low debt cost. Notwithstanding, obviously, a slight fall in rates, or at least market rates, we remain in a high interest rate environment and we have a very low debt cost. We have a very significant portfolio reversion, so the market rents exceed the rents we're currently receiving by a very significant margin, and more on that later on. We have a very robust balance sheet, so we have the lowest cost, longest duration debt pretty much in the peer group. And notwithstanding all those factors, our shares remain, even today after these results, at a discount in the region of 29%. So we're well placed, but the shares today, we believe, do look like very good value. The last point I'll make on this slide is we have made good progress in developing our strategy more focused on sustainability, and this is very much driven by enhancing further our approach to driving net income growth, and really ensuring that sustainability is at the centre of our proposition, partly in responding, as I say, to the decarbonisation that's required across the built environment, but also fundamentally because we think by doing so, we will have tenants that are prepared to pay us more rent for better quality buildings and enhance shareholder returns. So just focusing a little bit on the highlights over the 6-month period. So again, we've been clear, I think, in giving you views on the market, and we were quite early, I think, in calling at the top and expecting from mid last year a correction off the back of principally rising interest rates given the high inflation environment, and that clearly has persisted. Having said that, we continue to outperform at a portfolio level. So our underlying portfolio produced a total return including income of 1.9% over the 6-month period, which compared with the benchmark, so the MSCI benchmark index, in which all of our peers, generally speaking, are part of minus 0.6%. So good outperformance at portfolio level. And in fact, very encouragingly, all of our portfolio by underlying sector outperformed. So our industrial portfolio outperformed by 2%, our office portfolio outperformed by 3.4%, and our retail portfolio by 1.8%. So the performance really was driven by the industrials, particularly our multi-let industrials, where we saw very, very strong levels of rental growth. In fact, from the middle of last year up to the end of September, our industrial rents have gone up by about 8%. In the same way, and in context, during a period of time when average values, but not rents, values for industrial fell about 25%. So we're in a very interesting market, and I'll elaborate on that later. Obviously, key projects that have driven that rental growth is Stanley Green trading estate in Manchester. And Bradley will give you an update on that in terms of letting progress. And we've also made further progress creating new industrial stock, another operational net zero scheme that we've completed in Milton Keynes. You can see there on the bottom right-hand image on this page, which is shortly to complete. and we hopefully will deliver some good letting progress on that over the course of the next few months. Lots of progress across the portfolio. So I actually can't remember a time where we've reported almost 60 lettings within a 6-month period. And an interesting statistic is, if we look at the terms agreed on those lettings, rent reviews and other activity, it represented about a 7% increase compared with the valuer's assessment of rental value at the start of the period. So we are creating more value in rent than the valuers are assuming, and obviously that in turn is feeding through to the valuation performance. And importantly, although we have gone through the traditional summer lull, we have a really positive pipeline of letting activity, particularly on our multi-let industrial estates. We have a significant amount of the void that I've just touched on is actually under offer. So alongside the financial performance, we've also continued to deliver in terms of our existing sustainability objectives. Most notably within the global real estate sustainability benchmark, the GRESB benchmark, which is now the globally recognized benchmark for real estate sustainability, we scored 77 out of 100, which compares to 77 last year. And we retained a first position in our peer group of 6 diversified REITs, and REITs many of you will be familiar with. So good progress. A little bit more on the numbers. So what we've announced today is a net asset value, you can see at the bottom there, of 296 million, or 64.5 pence share. That represented a decrease of 1.6%, albeit with the impact of dividends paid over the period, that actually resulted in a positive NAV total return of 1.1%. So, it is a negative number in headline NAV terms, and we're doing our best to mitigate that. But I would say that actually that does compare quite favourably with the rest of the peer group, and particularly given obviously the current prevailing discount to NAV. The NAV therefore was principally driven by a fall in underlying property values, and over the 6-month period to September, our portfolio fell by 1.2% at property level, so pre-leverage, which compared to the benchmark on a like-for-like basis of minus 2.9%. So again, as I've noted, relative outperformance. We continue to invest capital expenditure in our key projects, so Stanley Green Trading Estate being the main one. So you can see there the 4.8 million of capital expenditure. And we have some other projects that have either completed over the period or ongoing, notably an industrial refurbishment in Swindon and an office refurbishment in Edinburgh, which Bradley will touch on later on. There is also a slightly interesting line there, gain related to interest rate hedging. That is actually a realised gain we made where we tore up an old hedge to put in place a new one, which was linked to an extension of our revolving credit facilities. Now, moving on to income, ultimately we all own this for income. And positively, if we compare dividends paid for the half year last financial year to the end of September 2022, our dividends paid increased by 5%. And really importantly, those dividends that we have just paid, and in fact we've announced a further dividend payable in December, were 102% covered by earnings over the period. So the 7.7% or whatever it is on the share price yield today is a fully covered share price yield. There's a little bit of noise in these numbers, so I will spend a little bit of time just explaining some of the details. So rent and related income, you can see there in the grey bar, that was up 1%. The noise I mentioned is we actually benefited from what we call other income, which relates to payments from tenants for dilapidations, so payments in lieu of tenants reinstating their premises at lease expiry, and that money we have recycled into the refurbishments we'll touch on a little bit later. We did see a reduction in our joint venture income, so that relates to 2 assets, one in Bloomsbury in London, another in Manchester. That was principally due to the fact that in 2022 we were still receiving arrears being paid following the pandemic. Going forward, and because we'd also incurred some leasing fees for this most recent period, we think the steady state income for joint ventures is somewhere between 1.6 and 1.7 million on a half year period. So hopefully that's clear. And then rental income from a direct portfolio was flat. As Bradley will explain shortly, we are expecting some growth there off the back of a very encouraging pipeline of lettings under offer relating to new developments, but also leasing up our void rates. Moving down the income statement, property operating expenses were up a little bit. largely down to letting fees, legal fees associated with that positive income earning activity. Fund expenses were down. That's largely because our fees in particular are linked to NAV. So whereas we have seen now fall, the underlying fees paid by the company fall. Bad debt provisions, write-offs, we're in a very good position as it relates to rent collection. The rent collection rate for the 6-month period was actually 99%. So we are trending ahead of the pre-pandemic levels, largely actually because of the pandemic, and we're so much closer to our tenants, and our systems and processes mean that we are very effective at getting the rent in. Obviously, with rising rates, and notwithstanding the fact that 91% of our debt is hedged or fixed, we did see an increase in finance costs because of that unhedged piece that we have in relation to our revolving credit facilities. And the intention, and we have some active disposals in process, is that through the sale of some smaller assets, we will use those proceeds to repay the unhedged components of our revolving credit facility. That ought actually to be accretive because the cost of that debt at the moment is probably higher than the assets selling. And that will also serve to bring the net loan to value back in line with our long run target group with the board of 25 to 35%. We are just outside of that at the moment because we've been investing capital into some of the projects that we'll come on to talk about as we go through. But overall, from an earnings perspective, in line with expectations, and I think positive versus peers. That in turn has allowed us to continue paying what we believe to be attractive level of dividend. And we've been very clear in the past, and I'll reiterate that the perspective from the manager and the board is as and when we believe we can pay a high dividend on a sustainable basis, we will increase it. Our aim here is to deliver a progressive dividend policy, and the strategic evolution we've announced today, we hope will allow us to continue doing that on an even more sustainable basis. Drawing some comparisons with the peer group. So what we've done here is provide snapshots based on the most recently published information for companies that investors generally consider to be our peers. We've anonymized them, but we have actually given the actual underlying funds details in the notes at the bottom there. But I think that the key point here is versus our peers, we have a higher income return supported by a lower cost, longer duration debt. And what we aren't showing you here, because actually it's quite hard to get behind the data with some of our peers, is alongside these characteristics, we have a significantly higher reversion than the average. So that reversion or the rental potential in the portfolio, we believe is greater than our peers. Even before that, you can see already along the top there, we have the highest dividend that is fully covered in our peer group. So a 7.7% dividend yield today, give or take, is 102% covered. There are others in our peer group. There are one or two smaller companies who are paying high dividend yields, but those are uncovered. And we would argue that they don't have the inbuilt reversionary potential that we do that gives us visibility on future earnings. Likewise, not because of those factors, we think our share price discount to NAV is genuinely compelling. So around 30% today. There are companies that have more significantly wide discounts, but in most cases that's because there is something quite significantly a risk. So for example, it might be a near-term refinancing, it might be much higher cost of debt. So we think we sit very nicely in relation to risk versus discounts, and really that's sort of the main point on the bottom line there. You can see pretty much the lowest cost of debt. There's one that's a bit lower than us, but most importantly, from a risk perspective, our average duration of debt is over 10 years. So we would argue, compelling in the context of the peer group and the way that the market's currently pricing that risk. Now, I'm not going to spend too long on this because the main purpose of today was to obviously communicate the results. But what we have done today, and we will potentially do a separate session walking shareholders through this in a little bit more detail, is how we are proposing to formalize sustainability at the center of our investment proposition. So this is very much evolution, not revolution, as it relates to the strategy. And what we're trying to do is use the specialist resources we have within the real estate team and the wider Schroders business to essentially make our portfolio even more resilient when it comes to our ability to lease space on the best terms in the most sustainable way. So how are we going to do that? So two key things you can see set out there. The first thing is that we are proposing to update our investment policy, and this is what the circular sets out ahead of the EGM on the 15th of December, to incorporate alongside the existing financial objectives, sustainability objectives and KPIs that bind us and the team, which oblige us to set out how sustainability is part of a strategy and then measure and report on delivery of those sustainability related objectives. We're going to have alongside that an enhanced governance structure. So this is something that we will be formalising in detail with the board in terms of setting out how we will be using our own proprietary ESG scorecard at asset level to have a quantitative approach to looking at the individual asset risk and then setting out how we're going to improve or mitigate asset risk, again, with the overarching objective of driving higher levels of net income growth. And for some of our shareholders, increasingly some specialist wealth managers, having the ability to report those improvements will be very important to them achieving their own sustainability related objectives. So why do we think this is the right thing to do? Well, I think first and very much most importantly is we think we will make more money for our shareholders. We think tenants will pay us more rent. We think we'll have more resilient assets, and therefore the long term, both income and total returns should be more attractive. The second thing we think it will deliver in a relatively crowded peer group is it will begin to differentiate us from some of those other peers who we would argue don't actively manage our assets as well as we do. I've touched on it, but we also believe this could attract new investors to the company who may have their own specific sustainability objectives. And to give ourselves the best chance of that, when the FCA, and we hope this will be this year, possibly next, when the FCA release its final sustainable disclosure regulations, we will be looking to align SRE with what we believe will be called a sustainable improver category, which is essentially what we're already doing, which is improving, transitioning assets. But in doing so and getting that category, we hope we can drive more demand for the shares. And that's really the last point. And it's not a cynical point, but we do believe that by differentiating ourselves in this way, alongside continued outperformance, we will hopefully be able to drive more demand for the shares and do something to address that rating in order that long term, if there are accretive growth opportunities out there, and there is one or two examples in the portfolio where if we were bigger, we would have much more potential to exploit them, is potentially facilitate that growth. Now, the last point I'll just flag is we've had a few questions saying, well, okay, what does that mean for returns? Other than simply saying it should enhance them. And we're using this as a sort of a case study on this slide. So what this shows you the performance of our underlying portfolio on a rolling 3-year basis to the most recent quarter end, 30 September. On the left-hand side, we can use data, and this is independently calculated by MSCI, showing the expenditure that we have made in the underlying portfolio. So over the 3 years to September, 20% of our total value today has effectively been new investments. That comprises 16% acquisitions, notably Stanley Green and Chippenham, both of which we'll come on to later, but also how much money has gone in through developments and improvement. And I think the key point we're making here is this strategy will probably mean we're investing more in our existing assets. We will be delivering more by way of asset improvements. And the reason we'll be doing that, and this is really illustrated on the right-hand side, is because we believe that will drive higher levels of rental growth, higher income, and more attractive total returns. And and again, I'm sort of tempting fate, but actually, if you look at the performance on the last 3 years, because of all that activity, our total return of almost 7% compared to the benchmark of just over 2%. So that active management approach is working. What we're saying is we will evolve that approach, more explicit focus on sustainability, because we think it will deliver us more by way of sustainable rental and income growth. So moving on to the market, I've only got a couple of slides on the market, and then I'll hand over to Bradley to go through a bit more detail on the portfolio. I guess the first point to note is we are, I guess, describe it as cautiously optimistic about the outlook, and this is talking very much from the perspective of our portfolio. We obviously had a favourable or more favourable CPI print last week at 4.6%, and the markets have reacted relatively positively to that. Obviously, with notably the 10-year gilt yield, what we would call the risk-free rate, falling from about 4.5% pre that announcement down to about 4% today. The reason I say we remain cautious is, of course, we are a very long way still from the Bank of England's 2% target. And as one analyst put it, it could be a long last mile to that 2% number, notably with wage growth still up or about 8%. But nonetheless, real estate values are closely linked to what's happening, particularly in relation to interest rates. And the fact that we have seen that with lower inflation print, the fact we have seen that positive reaction in money markets, means that we are moving towards, we believe, real estate looking fairly priced. So just to put it in context onto the next slide, on the left-hand side here, we're showing the capital value movement from the top of the market in mid-22. And you can see average values there, the dotted line, are down already about 22.5%. That's a property level. Our values, as it happens, are down about 15. So we've done a bit better than that, but it's still been pretty painful. And industrial values, interestingly, we think they are still the favoured sector in terms of rental growth, but because they had such low yields to start with, they were more adversely impacted by the rising rate environment, which is why they saw a 27% decline up to now from the peak. Albeit, as you can see with that dark blue line there, which is the industrial sector average, we are beginning to start to see monthly positive upticks in the main industrial index. Now, to put it in context, the GFC, we saw a peak to trough valuation decline of around 44%. So if we're down about 22% now, we think with the fact that the long run gap between property yields and gilts is about 1.5%, we're currently about 1%. We think there is a potential to still see a further decline in values, but we are a long way through the correction. And if you do, as we do, own majority industrial assets, you're going to do better than the average. But as I say, we are expecting a further reduction in valuations, but not material, and certainly not in the context of our current share price discount. The other key difference with what we saw during the global financial crisis is on the right-hand side, which is in contrast with sharp value declines, rents, at least in nominal terms, are still going up. So, for example, since June 22, average values falling 22%. Average rents have actually gone up by 4%. And in our case, because of that higher industrial weighting, and notably because of Stanley Green estates, our rents have actually gone up by 8%, so double the market against the backdrop of that quite sharp correction in capital values. The other point to note, which I think is why we are more cautiously optimistic, is in contrast with previous downturns, there is nothing like the same leverage in the market. So going into the GFC, average loan to values in the real estate market were around 60%. Today, they're about 35%. So there isn't that same leverage effect. And again, as a related point, and again, those of you that travel across the UK, in the major cities, outside of residential towers, very little stuff is being built. No one's building multi-let industrial estates. No one has really built retail for the last 10 years. And city centre offices, that there is now a shortage of the best quality space. And interestingly, in the strongest cities, and looking at across the city of London now, but also in the regions, prime office rents are getting to levels we've just not seen before in nominal terms. So I think there are reasons to still be cautious, but I think there are also reasons to be cautiously optimistic, given the relative health of the occupational market, particularly as office tenants are increasingly requiring their employees to spend at least 3 days a week in the office. So with that, I will hand over to Bradley.
Thanks very much, Nick. And good afternoon, everybody. Thank you for joining. Clearly, with the end of the ultra-low interest rate environment and no sign of that returning anytime soon, it's our view that future returns in real estate will be led by income and rental growth. And we believe that is best generated through active asset management. And we're going to touch on some examples of that in our portfolio as we spin through the deck. First, we thought we'd show you some portfolio level metrics. So in the table on the left-hand side, you can see we've highlighted some rows. So the first rows we've highlighted speak to the diverse and granular nature of our portfolio. 40 properties, more than 300 tenants. We think that spreads risks, and particularly as we're in this tough environment where interest rates are beginning to bite for consumers and businesses, we think this makes our tenant base, our portfolio overall, resilient. And the second set of rows we've highlighted speak to the higher yielding nature of our portfolio. So our net initial yield is 5.8%, which compares favourably to the benchmark of 4.9%. But also we have this staggeringly high reversion, which is 8.1% compared to the benchmark of around 5.9. Now, to put that reversion, to put some numbers around it, that's an additional 9 million of rent that we have to aim for. And to put that £9 million into context, our annualized dividend is around £16 million per annum. So, clearly, if we can capture some of that reversion, there may be the potential for us to continue to push that dividend on. Looking at the right-hand side of the chart, this sets out the structure of our portfolio in terms of sector weightings. And the key point to note here are the overweight allocations to industrial, which is almost entirely multi-let industrial estates, where we see really favourable supply-demand dynamics, as Nick mentioned earlier, but also retail warehouses, which is another area where we see rental growth coming through. So those two sectors account for around 60% of the portfolio weighting. Other sectors we have, and our offices are good quality. They've got good fundamentals. They're in good locations, city centres, where we see opportunities to push the rents on. And then our retail is mainly part of multi-sector schemes with really good footfall, good catchment. Finally, in the other segment, we've got 2 hotels, a car park, and a single small leisure scheme. Next, I thought I'd touch on briefly our tenant base. Our 15 largest tenants are listed here. We believe these are household names, really strong names, and we're really happy with this list. Only 2 tenants in our book represent more than 2.5% of the annualized rent. Probably one name that we'd mention here on the list that may raise eyebrows is Cineworld. We have just agreed a deal with Cineworld to slightly reduce their rent in return to avoid any CVAs in the future. But otherwise, the list is very strong. Those 2 names I mentioned at the start that are above 2.5% are University of Law, which is the largest external provider of legal education in the UK. It's a growing business, and they're actually taking more space with us in Manchester. And secondly, we've got Siemens Mobility Limited. Now, these are part of the global conglomerate Siemens, so clearly a very strong business overall. Now on to void, and Nick did mention our void is 11.2%. This is within the 10-year range of 5 to 13%, but that 11.2% is kind of artificially boosted because we just recently completed the development of Stanley Green trading estate in Manchester, which added a big chunk of ERV to our portfolio. Now, if we adjust for those vacant units, then the vacancy is 8.9%, which compares, I guess, more consistently with our past void. So that 8.9% is right in the middle of our 10-year range of 5 to 13. Not only that, we do have lots of activity underway since the period end. For example, we have 4.2% of the 11.2% either let or under offer or in advanced negotiations, and 1.2% is under refurbishment at Swindon, and we'll touch on that shortly, but we'd hope to let that at a higher rental tone when complete. I thought I'd touch on briefly Stanley Green. So taking a step back, we acquired this asset in December 2020 for around £17 million. And of that £17 million, £3 million related to a 3-acre development site. So it's just a brownfield piece of land, no real estate on it. Since we acquired the asset, we've spent £9 million in capex to build 11 new units of really sustainable warehouse accommodation. So that's over 80,000 square feet. So build cost was around £110 per square foot. These have been built to BREEAM Excellent and EPC A+. They're the first A+ EPCs we have in the portfolio, and is a sign of the direction we're heading. So we made a conscious decision here in spending that £9 million to, pay 10 to 20% higher to get those certifications such as BREEAM Excellent and EPC A+. And as a result of producing this really excellent accommodation, we've been able to attract good tenants on really good terms ahead of our underwrite and ahead of time. So, for example, a unit in this estate, the rents are 21% ahead of the units on the existing estate just next door. Now, clearly, some of that 21% is because the units are newer, but we believe a large element of that is because they are more sustainable. The energy bills for our tenants are lower, and it's a much better place for their staff to work. Now, what does the 17 million and the 9 million mean? Well, the valuation is 39.5 million at the period end. That's more than doubled what we paid for it. And the returns in the bottom table on the slide show we've strongly outperformed benchmark. So since we acquired the asset, we've made 21% per annum, and that compares to 7% per annum for the benchmark. So while Stanley Green is largely complete, subject to fully letting, we have highlighted here three initiatives that we have in the pipeline and underway. So the first column shows our Starbucks initiative, and we've spoke about this before, but in summary, we've got 1.7 million to spend, and Starbucks are building the pods, and when they're complete, that's when we pay the money, which will be early 2024. And we believe that will increase the value of the assets by around 2.5 million, or roughly, give or take, and we'll get another $250,000 in rent. Now, that rent is linked to inflation. It's on 15-year leases, so it's a good example of us generating these long-term leases with inflation kickers, which would be very expensive to buy. The yield to buy that would be very low, and it's activity like this that enables us to pay the high dividend and push it on over time. In the centre, we show the Ton in Edinburgh. So this is a recently refurbished office unit in the asset. This is a well-located city centre office with, we saw the opportunity to improve the sustainability performance of the asset and push the rents on. We've spent, as part of a project, we've got a budget to spend £2 million. It's almost complete. We've got about 200,000 left to spend. And once that's spent, and once we let the units, and they're all let except for one, which is under offer, then we believe we can push the value on here by around £2 million. And the unit that's under offer is actually the unit you can see in the photo. The ERV of the asset overall is around £23 per square foot, but we've been able to push terms to £27 and beyond on this unit, obviously subject to completion. On the right-hand side is an example of one of our multi-let industrial assets. This one is in Swindon, on a well-established industrial estate. So this is comprised of 3 units. In the last 12 months, all 3 have come back to us. One of them we were able to let almost immediately at an attractive rent of £7 per square foot, well, just over £7 per square foot. And the other 2 we've been refurbishing. And in undertaking the refurbishment, we have again focused on sustainability. We've pushed the specification on. We're aiming for a minimum of EPC B. We're going to put PVs on there and make it a really attractive space for an occupier. And we believe we can let these at around £7.50 per square foot. And to put that into perspective, the previous tenants were paying around £6. So that's a 25% increase. And we believe spending that extra bit of cash to get the better spec is going to pay off here. Moving on, so I'll briefly touch on Langley Park in Chippenham. So just to step back again briefly, we acquired this asset in December 2020. We paid £19.3 million. Post-acquisition, we've been really active on the site, and we've completed a re-gear with one of the major tenants for a 10-year straight lease. The rent's almost 30% higher than the previous passing. And we also agreed and completed a rent review with another major tenant, Siemens, for, again, a rental increase of around 30%. So that means that the passing rent is now, or the contracted rent is now £2.2 million per annum, which represents a yield on cost of around 11%, so clearly very attractive. Now, this asset is 28 acres. It's right in Chippenham town centre, next to the train station, so it's a really interesting location and interesting site. And there is scope to increase the massing at the site. So we have been speaking with a major tenant. I won't go into too much detail, but if we do pull this deal off, it will be accretive to the fund. And if we don't do this deal, which would be to, again, with the theme on sustainability, will be to produce a operation net zero carbon new headquarters for the tenant with, BREEAM Excellent, EPC A+, etc. But if we don't pull that off, we have the opportunity to put resi on the scheme. So there's some good optionality there at this site. We've discussed reversion throughout this presentation and talked through some examples of where we've already achieved higher rental tones and where we have opportunities to push the rents on post-activity. But we thought we'd set out on a slide, the steps to get us from our current passing rent as at 30th of September, so that's the 28.8 million, net insured of 5.8%, through to our ERV. Now, the first step we think about are fixed uplifts in the next 24 months. So this is where the lease contracts stipulate that rents will increase. We see 2.3 million there coming through in the next 2 years, but actually almost half of that relates to just 2 tenants, which will come through much sooner. So we have Little Fuse, who are at Langley Park in Chippenham. Their rent's going to come in at almost 500,000. And we also have New Buckinghamshire University, who occupy our office in Uxbridge. Their rent's going to increase by around another 500,000 as well. So almost half of this figure is from 2 leases, and it's going to come through imminently. The second step, so we mentioned Stanley Green. It was completed during the period. There's 1.3 million ERV to go for. We've let 300,000 of that. There's 1 million left to go, of which 60% is either under offer or in advanced negotiations. And once that comes through, that'll bring in another £1 million to our rent, which will be great for the fund. The second 2 bars summarize where there are, units and assets where the current passing rent is below the market value. So as we get those units back and as we execute rent reviews, we expect to be able to push the rents on there. And finally, we've got the vacant space, 3.3 million. And as you can see on the void slide, there's lots of activity there to bring the void percentage down and bring the rent up. And then the final point to note, there's a couple of developments that we've touched on for this portfolio. So I spoke through Starbucks, 250,000 of rent, and Nick mentioned Hodding Lane, which is another initiative at one of our multi-let industrial estates, and that will bring in another 250,000 of rent when complete. So that 500,000 of rent is not actually within our ERV, so that's a sort of bonus once it comes through and is let beyond that 8.1% ERV. So lots to go after in terms of capturing that reversion and lots of activity to do so. The final point I'd like to make in the slides is just to really emphasize the strength of our balance sheet. So the key kind of stats are on the right hand side there. The average interest rate on our drawn debt is 3.5%, and the maturity across all of our drawn debt is 10.2 years. And what underpins that strong balance sheet is the long-term loan we have with Canada Life, which is at a fixed average interest cost of 2.5%, so extremely attractive in the current environment. And the maturity of that loan is more than 12 years. And that loan represents about 75% of the drawn debt. So as we execute the strategy to bring down the net loan to value, which is currently 36.6%, we would pay down the unhedged RCF and expect that interest cost to come down. So really strong balance sheet there, and it really underpins our earnings. Moving on to the summary, and I'll hand back to Nick here for some closing comments, and hopefully we'll have some questions to address at the end.
Thanks, Bradley. Great, my mic is no longer muted. So yeah, thank you. That was very clear. So just to summarise, I think again, we're pleased with the progress that we've made over the period. Our returns continue to be supported by having a higher income return and a sector-leading debt profile that is underpinning current earnings with the portfolio reversion that Bradley's articulated, hopefully giving us potential to deliver a further progressive dividend in the future. We have a fully covered dividend. We had a 5% uplift year on year, or half year on half year. And we have conviction that by evolving our strategy, still with the same income focus, but with an even more rigorous focus on sustainability considerations will allow us to achieve the 4 things, which I will just recap at the bottom. We've got real conviction that this will allow us to enhance our long-term returns for shareholders. It will allow us to differentiate ourselves more from our peers. There are certain wealth management groups who are keen to find investments that achieve a certain sustainability standard, and that's our aim once SDR is made clear. But also, importantly, hopefully this approach and all the other engagement that we're doing, content on the websites, getting out there and seeing more shareholders will drive demand for the shares, more liquidity, and ultimately an improvement in the share price rating. So I'll pause there, Jake, and hand back to you.
Perfect. Nick, Bradley, thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Bradley, Nick, we have received a number of questions from investors. And if I may, I'll just hand back to you just to read out those questions and give your responses where it's appropriate to do so. And then I'll pick up from you at the end. Thank you.
Great. Okay. Thanks, Jake. So, thank you for the questions. So, the first one, which we've touched on, but it's worth going back to, is if interest rates have nearly peaked, but will remain roughly at these rates for the foreseeable future, what are the implications for the medium to long term? So, I guess just to add a bit of colour to that. So, as it relates to the bank rate at 5.25 today, I think probably with the questioner, there's an expectation here that the bank rate will remain at its current level at least until the second half of next year. As I mentioned earlier on, the risk of higher core inflation driven by the employment market means that 2% target is still some way off, and for that reason, we will be cautious about expecting a further step down in the actual bank rate ahead of time. Having said that, and this is relevant to real estate specifically, investors that are borrowing to buy real estate will typically use interest rate swaps, and the typical duration might be 5 years for those interest rate swaps. And the expectation that rates will fall is already being felt in the swap market. So, for example, over the course of the last 4 weeks or so, the cost of fixing effectively on a 5-year basis has gone from a swap rate of about 4.5% down to about 4%. So if you overlay the margin on top of that, that would mean a fixed rate effectively for the 5-year period of around 5.5%, 4% fixed rate, 1.5% margin. So that has already come down from the very high levels that we saw so sort of earlier this year, and again, obviously having peaked after the mini budget last September. So I think what I said earlier on holds true in that ultimately, as a hybrid asset class, real estate has the characteristics of a bond, but also of an equity in terms of the rental growth that you can extract, particularly through active management and investing in the asset. If we look at the long run relationship between property yields and gilts, the 10-year risk-free rate, you'd expect that over the last 20 years to average at about 1.5%, and the gap is currently 1%. So really simplistically, to get to fair value, either real estate yields have to move up another 0.5%, or gilt yields have to fall another 0.5%. And the answer is probably they will both move a little bit. So that's why I think we're guiding to expect a further smaller step down in values before the average values bottom out and we see a recovery. But that's also why we made the point about rental growth, if you like, the equity part of the hybrid asset class. Because whilst we have seen this capital market volatility, rents are still going up. And it may mean, therefore, that long-term relationship means that investors are prepared to accept a slightly smaller premium because in the expectation that they will get rental growth. And in fact, that's what we're already seeing in the industrial market, where we are seeing industrial transactions trade in the low 5s, high 4s in some cases, because investors are expecting that with growth, they will see that yield increase to 5 or 6% over the short to medium term. So I hope that answers that question. Now, the next question, if you put yourself in the shoes of a typical institutional real estate investor, why would you not be buying SREI on such an attractive discount dividend yield? Well, that is a very good question. And that's what we're trying to remedy, because we do think the company represents great value, and we're trying to demonstrate that quarter on quarter, but also the strategic evolution is there to hopefully have more focus on us. I think sort of outside of that, I think partly it's scale. I think for lots of the wealth management groups, as they get bigger, and reference obviously the Investec Rathbone merger, they typically want bigger companies as they themselves get bigger. And so I think if we were twice the size, we probably would have more demand for our shares. That's also back to what we're trying to do in terms of strategic evolution, because if we can make ourselves more attractive, more differentiated, then we will hopefully create those growth opportunities. I also think there is nervousness in the market. I think amongst institutional investors, we are in the middle of a paradigm shift, really, of DB investors, defined benefit investors, de-risking because of the interest rate environment, moving into fixed income effectively. And a number of those DB investors own real estate funds. And so there are more sellers of real estate funds at the moment, and both institutional, but also retail as well. A number of you will have read the headlines about St. James's Place, for example, their property fund. And I would say in response to that, yes, that is a sort of a structural change. But actually, at the same time, trusts like this are a really efficient way to own real estate. So as part of that transition, we would hope that we may see investors who perhaps previously would have invested within open-ended property funds coming into closed-ended funds where you don't have those same liquidity pressures. Yes, you have the discount, but we would argue at this point in the cycle that discount looks good value. So again, I hope that answers the question. I'll just, the next question, Bradley, you may want to take it, just if you can read it from there, just in relation to Chippenham.
Yeah, so the question says, the figures mentioned the figures mentioned last time seem to have a very low increase in value considering the amount needed to be invested. So this is at Chippenham. Could you go over these again, please, and clarify the expected valuation creation? So, as I mentioned in the presentation, we're not going to go into detail on the numbers today, but it is a very accretive initiative for the fund. And because it's such a large initiative, it would really move the needle as well for the overall fund performance. And the appraisal stacks up from our perspective.
Yeah, I think the only thing I'd add to that, Bradley, and you did touch on it, but I think it's worth reiterating as we did last time, is Chippenham has been a great deal for us. We're running on a property level cash on cash return over 10% because of the asset management. The initiative that Bradley's talked to could be very accretive, but at the moment it is arguably too big for us. And so we are considering, if that transaction looks like it could proceed, we are looking at ways that we could potentially fund it, and it may be through disposals, could be through joint venture arrangements, but equally it may still not happen, Bradley has said. So I think we're giving as a really interesting example of the types of opportunities that we can create on these estates. And the great thing about Chippenham asset, because it's so well located in the town centre, is even if the transaction we've guided doesn't happen, we're clipping 10%, and actually down the line there could be alternative uses like residential that we choose to proceed with as an alternative. Bradley, do you want to just take that last question before we hand back to Jake?
How has our performance been compared to our peers?
I've just seen that pop up. You can take both actually. Why don't you take the Stanley Green question, sure, and then the performance question?
So at Stanley Green, there's a question: can we talk about the incentives for new rentals at Stanley Green on the new estate, and are there significant rent-free periods? So looking at Stanley Green specifically, we've actually, the team have done a good job in where we have done deals. They're for longer term, so we've actually got a couple of 10-year leases straight, and where the rent-free period is commensurate with that length of lease. So, for example, there's a 10-year lease with a 9-month rent-free period. We've got some leases out of 10 years with a 5-year break with, sort of 3 months rent-free period. So, and these are with good tenants. And also often we've got some inflation kickers in these leases as well, which is really interesting, and some deposits as well. So I think overall the terms are very strong, and the incentive that we're having to provide is, fairly limited for the quality of the lease that we're agreeing. Anything you'd add, Nick?
Only as a related point, actually, there's another question that's come in. Just when you say that 60% of Stanley Green is under offer or in advanced negotiations, is that on top of the 40% let? It is on top of what is let. What is let is actually 30%. So we've completed 30% of the lettings, and there are an additional 60% of lettings, which, as Bradley has said, are either under offer or are in advanced negotiations. So that is a key focus for us over the rest of this calendar year and into the last quarter of this current financial year. So just a couple more points here. So how has performance been compared to peers? So I guess just firstly, the MSCI benchmark data I gave you. So within our MSCI benchmark are all of the immediate peer group, so the other investment companies, but also the internally managed REITs, the British Land Securities, and also a plethora of other property funds. And on any period at property level, we've outperformed. And actually, if you draw down and look at the immediate peer companies, and we've named some of them in the chart, the likes of AEW, Picton, Standard Life, etc., our performance scrubs up well, particularly over the course of the last 12 months, as we started to see the benefit of positioning more towards estates like Stanley Green and other examples. At share price level, recently, and particularly since we have done the refinancing, our rating relative to peers has improved. So our rating now, high 20 discounts, compares favourably with one or two now who are trading at as wide as -40, where those companies have more refinancing risk. But really, our objective is to do much more to close that discount. And again, going back to the strategic evolution, that's a key part of it, trying to be more differentiated, trying to drive a wide range of shareholder demand to try and improve the rating, and that in turn potentially creating growth opportunities. And I guess that's a neat segue into the question here. You've mentioned a few times that you're too small for particular deals. Would you look at REIT mergers to get bigger? Look, it's a great question. The answer is yes, we would, but we are unable to issue equity at a discount. So any sort of M&A activity would need to be probably on a NAV to NAV basis. That is not completely out of the question, but we are in a position of strength, and therefore, if we were to look at M&A activity in that way, then it could mean that our dividend per share would be diluted. Now, that might be something that is in the long-term interest of shareholders if we can do bigger transactions, create more money over the medium term. But there are those issues around growth which mean that we've been much more focused on, if you like, plan A, which is growing net income, improving the rating, and now, of course, the strategic evolution. And if we get those bits right, then at least in theory, our rating should improve, and that puts us hopefully in a stronger position if there are those M&A opportunities down the line. But we are trying hard not to get distracted and to ensure that we focus on the priorities of growing net income. So, Jake, I think we've covered all of the questions, I think, Jake. So just given we've got 5 minutes to go, shall we hand back to you before we wrap up?
Absolutely, Nick, Bradley, thank you very much indeed for addressing all of those questions that came in from investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately afterwards, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. But Nick, perhaps before really just looking to redirect those on the call to provide you their feedback, which I know is particularly important to yourselves and the company, if I could please just ask you for a few closing comments just to wrap up with, that'd be great.
Yeah, thanks, Jake. Well, first of all, most importantly, thank you everybody for joining and for engaging so much with those questions. It is appreciated. And as we did previously, or have done previously, if we get questions in that we haven't answered, we will answer those post meeting. Just very briefly, we believe we are well positioned. We do have a high income yield. We have a very significant reversionary potential, and we have a very low cost of debt. We are pulling all the levers we can do to deliver high levels of income for you as our shareholders. The strategic announcement today in relation to the evolution of a strategy is not a revolution. Don't worry that things are going to change fundamentally. It is the same investment objective, but we believe that being much more upfront about how sustainability is a critical part of our asset management process, we will be able to drive, again, medium, long term, higher income, higher total returns for our shareholders. So for those that are holders, thank you for your support, and we hope to give you further updates on activity in the not too distant future.
That's great. Nick, Bradley, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Schroder Real Estate Investment Trust Limited, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.
Thank you.